Hello again, everybody. Let's chat about how much you're able to contribute to a Roth IRA in 2023. Terribly exciting, I know. Try to contain yourself. There's a few things to consider. First is the overarching maximum dollar amount of contribution the IRS allows into Roth IRAs in 2023. Specifically, if you will be under 50 years old as of the end of 2023, you can contribute up to the maximum limit of $6,500 for the year. Or if you'll be 50 or older as of the end of 2023, you can contribute an extra $1,000, so $7,500 in total for the year. That's sort of limit one, bound one. Also within that, you need to keep in mind that you're only able to contribute up to the amount of your earned income. What's earned income? This is income you get from wages if you work for someone else, or if you're self-employed, it's your self-employment income. There's a little more to it than this, but self-employment income is basically your gross revenue from your business minus your expenses from your business. That net is your earned income. Again, a little more to it, but that's for all intents and purposes the basic gist. If you work for someone else, it's specifically the reported taxable wages that'll show up on box 1 of your W-2. So why does that matter? So for example, if you have $10,000 for the year of gross income from working from someone else, gross wages, but you contribute, let's say, $6,000 to a traditional pre-tax IRA, it's only going to be $4,000 that shows up in box 1 of your W-2. For purposes of how much you're able to contribute to a Roth IRA, you're going to be capped out at your earned income of $4,000. So even though you made 10 in total, 6,000 of it was deductible, tax reducing because you contributed to your 401k. It's only $4,000 of net earnings that the IRS is going to look to say, hey, you can't contribute more than $4,000 to a Roth IRA because that's the maximum amount of your earned income. Make sense? So that's the second sort of bound or limit. The third one is based on your modified adjusted gross income, or MAGI, M-A-G-I. You can find a link in the notes to this video from the IRS that details the specific MAGI limits and what they mean. But in a nutshell, if your gross income is over a certain level, you're completely phased out from being able to make any Roth IRA contributions. Not to 6,000, not to 6,500, not to 7,500, nothing, zero. If your MAGI is below the phase out level of income, you can make up to the full amounts we just talked about, either 6,500 or 7,500, depending on your age, but then also subject to the total amount of your earned income. And if your MAGI is somewhere within the range of those, the lower and upper bound of MAGI limits, then you can make a prorated, gradually phased out amount, or phased down, I should say, amount of Roth IRA contribution. So what are the limits? Again, you can find more in the link below. But for 2023, if you are a single tax filer, the range of MAGI limits is $138,000 to $153,000. Again, if you're below that, you can make up to the full contribution. If you're beyond that, you can't make any. If you're somewhere in the middle, you can make a prorated, gradually reduced amount of contribution. If you are married and file a joint return, the MAGI bounds are $218,000 on the low end, $228,000 on the high end. Again, you can see all that below. There's also some special exceptions if you are married filing separately, for example. Check that out. And again, you can find the link to the IRS site in the notes of this video. One other thing I want to touch on, what is MAGI exactly? Well, by definition, it's modified adjusted gross income. So you start with what your adjusted gross income is going to be on your 2023 tax return. Generally, it's always, not always, but historically, it's been line 11 on your Form 1040 tax return. That's your adjusted gross income. And then you modify it by adding or subtracting certain things. So in the case of the MAGI used to determine your Roth IRA contribution eligibility, you're going to start with your adjusted gross income straight off your tax return. Again, generally line 11. You're going to subtract out of that any Roth conversions that were included in that, if you did any. So again, you strip that out from your adjusted gross income. And then you want to add to it any deductions you took for making traditional IRA contributions. There's also certain other few things you add back in, like student loan interest deductions. There's a few foreign income related deductions. But check out, I don't want to belabor the point here, but check out IRS publication 590-A. That will have the formal formula, if you will, for how to calculate MAGI. Also, if you do your own tax returns, or even someone else does them for you, tax return software will do this all automatically. You don't need to sit there and manually grind out this stuff unless you want to for learning sake. But tax prep software or tax return preparers will quickly and easily figure out MAGIs for you. Which brings me to another point. I recently did a video, what happens if you over-contributed and made an excess contribution to a Roth IRA. For example, you made a full contribution earlier in the year thinking your MAGI was going to be low and within the limits. Come to find out you got a big, fat, juicy bonus at the end of the year that popped your income over the MAGI limits. Now, oops, none of that contribution I made was eligible. So there is a process to undo it or recharacterize it. Check out the other video I did not too long ago about that for more information. One other thing I forgot to mention regarding the needing to have earned income to make a Roth IRA contribution. If you're single, everything I said before holds true. If you're married and file a joint return, not a separate return, but married and file a joint return, it's possible that one spouse doesn't have any income, earned income, or even has really low earned income, yet can still potentially make the full amount of Roth IRA contribution. There's something called a spousal Roth IRA contribution, which in effect, when a couple's married and file a joint return, the non-working spouse can look to the total earned income of the working spouse and consider it, functionally treat it as his or her own. So both spouses could potentially make the full $6,500 or $7,500 per year contribution each if the working spouse's total earned income is at least as much as the sum of the two contributions each spouses are going to make. So that's a neat little trick to be aware of. Not many people are aware that even exists. So it's nice. Okay, that's it. Hopefully you found this helpful. Thanks for watching. See you next time.